And welcome back to the Lance Roberts Show podcast here at realinvestmentadvice.com. Our special guest today, Pedro da Costa, author, reporter, and writer. He just told me, he just broke it here. Breaking news on the Lance Roberts Show. He's writing a book. What's the name of the book, Pedro?
Men the Fed is my working title.
I like it. So there we go. Men the Fed. We're going budding author right here, but also great reporter. Writes for Market News International, Forbes, Market Watch, and of course has a long history of articles. And we publish his articles every week as well. So Pedro, right before the break, we were talking a little bit about this kind of outlook for the economy that the Fed's dealing with, and they're trying to balance, their messaging relative to what's actually happening in the economy. And you mentioned about the effect of Fed policy. And one thing that I wrote about very early this year and actually part of last year was beware of what you wish for with rising interest rates, because, we had a lot of people coming out saying, interest rates are going to go, as you said, Jamie Dimon, interest rates 4%, et cetera. I said, be very careful with that, because we have an entire economy built on leverage, whether it's housing or corporate debt, that was all financed and driven around ultra low rates. And interest rates at, when you have a house note and your house note goes from 4% to 5%, it's a 25% increase, in your interest payment. And with a lot of Americans really living paycheck to paycheck and have not really experienced the wealth effect from the rise in the market. It's been very contained to really about the top 10, 15% of the economy. Those make an important immediate impact on people that are making monthly payments. And we're already starting to see that in the housing market, auto sales, all showing signs of softening. Do you think that is also feeding into kind of the Fed's considerations about, their quote unquote effective neutral rate on where they raise rates to?
I hope it is. I'm not sure about that. That's a question that I like the way you framed that. I'll next time I get a Fed official on the record or off the record, I'll phrase it to them that exact way. But I hope they're taking it into consideration, because they tend to focus on the macro GDP, number and the headline unemployment rate.
Right.
But we have a very bifurcated economy, as you pointed out, where people don't see the benefits of growth, and they definitely do see the downsides of even small increase in interest rates. Mm-hmm. And so I think that, yes, the Fed is starting to become cognizant, at least, of the effects of its own policies. And that applies to the overseas outlook as well, right? Because, there was always the very obvious prediction that the party was going to end at some point, and as the Fed started to hike, that the emerging markets would not fare so well. And sure enough, the weaker ones have shown significant signs of strain, places like Turkey and Argentina and South Africa. But I think the main worry for everybody is really China, because people talk about EM. Everything is small potatoes. China is the big kahuna. That's the too big to fail economy. And that's one of the reasons why the market, I think, has been tanking, and why, even the Fed's own sentiment has changed, is that there's a sense that despite this sort of pretend kiss and make up between Trump and Xi Jinping at the G20, that it's really not over. And, and especially after the arrest of the Huawei CFO, that this is a trade where corporate leaders start to get arrested. I don't know if you saw, but today the retaliation was that a former Canadian minister who's now a businessman in China was also arrested. So this doesn't look very good. And if the two largest, and when I heard on CNBC, an analyst say, like, if I were an American CEO, I'd be afraid of traveling to Beijing right now. That's pretty severe, right? That's well beyond a trade war. That's like, that gets into the military sphere, to be honest. So that's pretty frightening.
Well, no, look, there's, it doesn't take a historian very long to go back through history and look at the impacts of trade wars and how trade wars tend to wind up in shooting wars ultimately because of exactly these things, right? And just for the record, I'm not saying we're about to wind up in a shooting war with China. I'm just saying that historically speaking, when you start applying tariffs, they tend to result in other outcomes that are always the less intended consequence, right? The unintended consequence. And, we're particularly seeing that now. And I thought Doug Cass summed it up really well when he said the G20 meeting was more like he said, she said. So
I love that one. That was great.
But but the point here is, and this is a question to you. So, we've had tax cuts earlier this year. The market really didn't respond to that. And now, unfortunately, we're at the end of the year. So when we begin comparing earnings growth next year, we begin to do that on a year-over-year basis. So the effect of the tax cut for corporate earnings growth is going to disappear next year. So earnings growth rates are going to fall more back towards the rate of revenue growth and, of course, economic growth, which is potentially going to be running between 2 and 3%. Then we look on the other side, we've got these trade wars and trade tensions that are going on. We've already had corporation after corporation with corporate earnings coming out saying, hey, trade wars aren't working for us. The tariffs are hurting our earnings, and what's happening overseas isn't good. And then not to mention, of course, as you stated, the geopolitical stresses, not just with China, but also with a variety of other countries. It seems to me that the markets are beginning to understand that the U.S. cannot remain this island of economic strength in the midst of the world that we live in today, and that we're ultimately probably going to play catch up with the rest of the world at some point, maybe sooner rather than later. I wanted to get your thoughts on that.
I think that's absolutely right. I think the international outlook, and that's part of the, what everybody's been saying about trade wars. And of course, the Trump administration is not going to listen because that's kind of the core philosophy. Mm-hmm. But, basically, in order to have a successful trade war, you have to get China's economy to suffer so badly that you're hurting yourself, right? Because you depend on China's economic growth. And if you watch that growth collapse, then your market's going to suffer and your growth is going to get hurt. Right. And so, like you said, the interconnections are so great. And now we see, French growth struggling and European growth kind of, which was it had been a leading light for a year or so. Now that's kind of struggling a little bit. So it's hard to see where the future sources of growth are going to come from. And, it's more about an environment of retrenchment now than one of expansion.
Well, it's an interesting point when you talk about France, and really it's France, which I thought was interesting. When you take a look at France's economy, they're heavily indebted and economically becoming more risky, overall, particularly when you take a look at what's happening with the French revolts, et cetera, that are going on right now. And yet their solution was to cut taxes and raise wages. So, it seems that we have country after country following the same prescription of this idea of almost kind of catering to populist ideas, which is, cut taxes, raise wages, and that's somehow going to magically fix your debt problem, which is exactly the same problem we have in the U.S. Here's my big concern, Pedro, between you and me and the Fence Post and all of our listeners, which is that we're running $1 trillion deficit in an economic expansion. That's my big worry, because that has never historically worked out well. And particularly when you look at what's happening overseas, it seems that we're replicating the same bad economic policy globally, not just domestically.
So I would disagree with you in the following way. I'm very deficit dovish when it comes to the United States.
Okay.
But the United States is a very particular case. We have the world's reserve currency. We don't have we are a currency union in the sense that all of our states use the same currency, but we're an independent sovereign state that can issue debt unlimited. We don't have an inflation problem. So I don't see the deficit as a problem in the United States. In France, the deficit becomes a problem. And now Macron is stuck between this sort of like, either he caters to the protesters and grants some spending and wage increases and then gets downgraded by the rating agencies, or vice versa, right?
Right.
Or he gets props from Wall Street, but then he gets yellow vest protests on a daily basis that he can't really live with.
Right.
But the problem with France is that they're stuck in the EU, and the EU hasn't decided to issue Eurobonds yet. So if the European Union were a full fiscal union that could issue bonds, then yes, it would have the fiscal firepower to potentially use the deficit in a productive way.
Right.
And the other distinction I would make is that I wouldn't even call our move here populist, because as you noted earlier, the tax cuts were overwhelmingly focused on the rich. So
right.
It's a strange kind of elitist populism to focus on the estate tax, right? I mean, right. At least a real populist president would at least give some bread and circus to the people. And there's not much bread and circus to go around in the States. At least in France, they kind of, but in France, it might even be harder because the political parties are very entrenched. If you look at the yellow vest protesters, the more
right.
I learn about them, it's kind of fast. There's there are right-wing and left-wing factions within that protest. So it's very complicated politics that that I'm only kind of getting my head around now. But it doesn't look like Macron's future is very bright politically.
Yeah, no, there's no doubt about that. And it's interesting, too, because you're actually seeing the same thing occurring in Germany with Angela Merkel. Her political hold over Germany has been eroding over the last several years. So you're seeing the same kind of issue with a lot of the major governments around the world. Is this kind of this underpinning? Take a look at what's going on with Theresa May, and of course the whole Brexit issue.
Yes,
it's a big.
The populist wave is definitely a global phenomenon, and I wouldn't even call it populist. I'd say it's sort of proto-fascist in some places. I'm originally from Brazil, and we do have pretty much a fascist president-elect, and God only knows what's going to happen when he takes over in January. Yeah. But it might be violent, because I think there are going to be a lot of protests, and he's not going to hesitate to use military force. He's surrounding himself with generals. He has, sadly, fairly overwhelming popular support because of the level of corruption that happened in the preceding administration.
Right.
And if you think about it in terms of global growth, right, people don't think about Brazil because Trump takes so much oxygen in the news that you don't think about Brazil as much as one should. But it is the second largest economy in this in the Americas, and
right.
It could have a pretty strong ripple effect on other places.
No doubt about that. Well, Pedro, we've been talking with Pedro da Costa today, reporter for Market News International, also Forbes and Market Watch. Anything I didn't ask you today that you think is important that you'd like to talk about?
So I did want to tell you one funny story about Fed communications and rookie mistakes, if you don't mind.
Sure.
So Bernanke's rookie mistake is probably the funniest one. Bernanke goes to the White House Correspondents' Dinner. I think he had just taken office, right? He just started becoming chair. And he attended the White House Correspondents' Dinner. And he sat at the CNBC table. And he chatted, apparently, with Maria Bartiromo and others. Mm-hmm. Sure. Now, the ground rules of the dinner is that it's off the record, right? Mm-hmm. So none of what they say to you then are you supposed to use for your reporting, publicly in any way, shape, or form.
Right.
And that the following Monday, this is on a Saturday, the following Monday, Maria Bartiromo, I'm sitting at the Reuters office watching CNBC, and Maria Bartiromo is at the CBOE in Chicago interviewing then Chicago Fed President Michael Moskow. And halfway through the interview, she didn't seem to realize what she had, or because she didn't break the news. She just kind of slipped it into conversation. She said, President Moskow, I was talking to Ben Bernanke this weekend, and he told me the market totally misinterpreted his remarks, sort of as overly hawkish or overly dovish. I can't remember the direction, but basically the pit behind her goes wild, okay? The pit behind her starts, rah! Almost in like a movie-esque kind of manner. And here's the kicker. She and Michael Moskow didn't realize why the market was moving. So she goes, "Oh, I wonder what's happening." And he turns to her and he says, "Oh, they're probably just excited that you're here, Maria." And it was one of the best moments of CNBC I've ever watched in my entire life. And you know what happened? Bernanke never attended one of those dinners ever again because we'd invite him every year, and he became a lot more reticent about talking to reporters, unfortunately.
Look, and I will say this. So I've been in the market since 1987, and I do think that, I know you like the speed of information. We talked about that earlier, but I do think that maybe in a lot of cases, market information moves too fast these days. Yeah. And that, I do personally long for the days where, it actually took a couple of days to get earnings announcement out so that we weren't, scalping $300 billion in market cap off some company because they missed, a penny's worth of earnings, right? And
I see your point. I see your point about being able to digest information before you make investment decisions.
Exactly. Yeah, that's really just my point. High frequency trading and what's going on, I think is going to be
sure. No, but that's a point. But that I would argue that's an issue about properly regulating markets so they function well, rather than offering them less information. Because right. I think information is just good for the investors, period. Unless it's sort of a cacophony. Like I said, I think Fed officials should do some level of coordinating and not speak over one another, one hawk and one dove speaking on the same day. There should be some level of coordination, but that's not an argument against transparency. It's an argument for cohesive messaging.
Exactly, right. Well, Pedro, hey, I really appreciate your time today. It was an awful lot of fun, and I would certainly like to do this again sometime with you, and particularly as we have stuff coming out, from the Fed and kind of what's happening. Particularly, I think 2019 may be a lot more challenging year than many people expect. So I'd certainly like to have you back to talk more about that, keep people up to date.
My pleasure. I really enjoyed it. Thank you so much.
Appreciate it. Pedro da Costa, you can find him at Market News International, Forbes, and Market Watch. And of course, every week on our website, realinvestmentadvice.com, for our reading list, you'll find his articles there as well. And we'll see you next time on the next edition of Lance Roberts Show right here at realinvestmentadvice.com.
Want a longer talk with Lance about your money? Request a personal one-on-one at realinvestmentadvice.com.